Hello friends, a very warm welcome to my channel. In today's video, we are going to analyze a company called Meghmani Finechem Limited. It's again a recent special situation, and now this company is growing very quickly on an individual basis. So before we begin, if you're new to the channel, please do subscribe and activate the notifications by hitting the bell icon, because you'll get a notification whenever I upload a new video. And if you're not a part of our Telegram channel, do join right now, because we discuss on our Telegram channel daily the market analysis, the views, and a lot of interesting stuff. So let's get started. So Meghmani Finechem Limited was earlier a subsidiary of Meghmani Organics. In 2007, it was incorporated as a subsidiary of Meghmani Organics. And in 2021, it got demerged from Meghmani Organics into a independently listed company. Now, what does this company do? This company is into manufacturing of bulk chemicals as well as specialty chemicals. It was mainly into bulk chemicals earlier, and now it is transitioning itself into a majority of business from the specialty chemicals business, as it is more margin accretive for the company. So it manufactures chloralkali products as well as the derivatives or value added products. And now the second generation entrepreneurs have taken over in the promoter's family. The company is also entering into products which are substitute for imports like the CPVC resins. And interestingly, the company has done the forward and backward integration of its products. So a lot of products which the company manufactures are captively consumed in-house. There are more than 850 employees working for the company, and the company has capacities of chloralkali to the extent of 315 kilotons per annum, derivatives of 190 KTPA. Now briefly, let us discuss the history of the company. In 2007, it was incorporated as a subsidiary of Meghmani Finechem, and in 2008, International Finance Corporation invested about 25% stake in the company. In 2010, they started their greenfield project of 119 KTPA relating to the caustic soda, which is again a bulk chemical, and also a power project of 40 megawatts. In 2015, their project was expanded to 167 KTPA, and the power project was also expanded to about 60 megawatts. In 2017, they commissioned another product, which is potash plant of 21 KTPA, and in 2018, they expanded their caustic soda plant and also started new facilities for manufacturing CMS, which is they entered into the methane products. In 2020, they commissioned another CMS plant of about 50 KTPA, and they announced the entry into another new product, which is epichlorohydrin, with a capacity of about 50 KTPA. So throughout the journey, you can see that the company is expanding the production capacities of its existing products, as well as the company is diversifying and entering into new chemistries. In 2021, again they expanded the caustic soda capacity to 294 KTPA now, and their captive powered plant to 96 megawatts. So earlier they started with 40, and now they have reached 96 in 2021. They also started a new plant to manufacture H2O2 with a capacity of 60 KTPA. And recently in 2021, they announced their entry into another new product, which is CPVC resins. This capacity of 30 KTPA, and interestingly, this is an import substitute product, as 95% of these products in India are imported presently. So the Make in India will get promoted by manufacturing this product in India, and this company will have a lot of support from the government as well. In 2022, this company was separated and listed as an independent entity on the stock exchanges, and they also entered into a new chemistry called chlorotoluene and further value added products in this chemistry. So as you can see, the journey has been very inspiring and interesting, as the company has diversified into various chemistries, as well as in terms of capacity, they have been continuously doing capex throughout the decade. Now, before we take it forward, let's talk about the management of the company. The chairman and managing director of the company is Mr. Maulik Patel. He is the second generation of the promoter's family. He has done BE Chemical from Sardar Patel University, Gujarat, and he has done his Masters in Chemical Engineering from University of Southern California. He has done MBA from US, and in the chemicals business, he has an experience of close to 12 years. So this is broadly the business model of the company, or the value chain of the products which the company manufactures. It looks complicated, but let us just have an overall discussion about this. The left side are the raw materials which are used in the production of the products, and the right side are the end products. The finished products are in the dark blue color. So the raw materials like coal, sodium chloride, and potassium chloride are used to manufacture the intermediates like caustic soda, caustic potash, and these in turn get manufactured into value added products like caustic soda lye, caustic soda flakes, and caustic potash flakes. Then products like methanol, sulfuric acid are converted into HCl gas, and ultimately the end products in the value chain are liquid HCl, methyl chloride, methyl dichloride. So these are the end products. Then in their other chemistries, they use solvents, alkalis and glycerine, PVC resins, and they manufacture end products like hydrogen peroxide, epichlorohydrin and CBPC resins. So on a broad basis from this chart you can understand what are the base products or raw materials going into their value chain and what are the end value added products and the intermediates which this company is manufacturing. Now let's talk about some key products of the company in detail. The first one to begin with is the chloralkali products, which is caustic soda. So in terms of production, caustic soda, this company is the fourth largest producer in India, and this is a bulk product which is manufactured globally. So this product is also useful as their captive product in manufacturing the downstream products like CMS, H2O2, which this company manufactures itself. And the end users of these are industries like alumina, textile, chemicals, etc. The next product in this chemistry, the key product is caustic potash. In this, the company is the third largest producer in India, and these are used and captively to produce products like CMS, H2O2, ECH, and this product is majorly consumed in industries like agrochemicals, pharmaceuticals, etc. The next segment which we come to is the derivative products or the value added products, which are kind of specialty chemicals. In this, the company manufactures chloromethanes in the methane chemistry. For this product, the company is the fifth largest in India, and they manufacture products like MDS, chloroform and CTC. These products are majorly used in industries like pharmaceutical, refrigeration, etc. The next product in this value added category is the hydrogen peroxide. For this product, the company is the third largest in India. So across all the products categories, at least in their key products, you can understand that the company is among the top 5 producers in India. So this product's demand is continuously growing as it is being used in different industries like paper, pulp, textiles, chemicals and various other industries. The next product in the specialty category is the CPVC resin, which the company is recently started. This product is used to manufacture plastic pipes, as you can see from the screen, and other plastic products like the ducts, etc. This is an import substitute product. A majority of these products, close to 95%, is still imported in India. And the company is setting up the largest CPVC resin plant in India. And as you know, CPVC products are used in the plumbing ware as well as in irrigation sector. The next product we are going to talk about is the ECH. Meghmani Finechem is the first company in India to produce ECH in a sustainable way, and this company has some advantage as the raw materials of this product are captively produced by the company itself. This is also an import substitute product as the majority of the products are imported in India. And this is mainly used in adhesives as well as the automobile industry. In terms of segment, presently the company manufactures about 74% of the bulk chemicals under the chloralkali chemistry, and in the value added or the specialty chemicals is just 26%. So gradually the company aims to manufacture more in the specialty segment and less in the bulk segment going forward. Now let's talk about the industry in brief. The Indian chemicals industry was valued at about 178 billion in FY19, and this is expected to reach a size of USD 304 billion by FY25. So there is huge tailwinds in the industry. Specifically, the chloralkali market was estimated at around $84 billion in 2021, and this is expected to grow at a CAGR of about 5.5%, close to about up to the year 2031. China Plus One strategy is also generating a lot of tailwinds for the chemical manufacturing companies in India. There is a custom duty of about 7.5% levied on the imports of caustic soda, which is promoting the domestic industries. Now let's look at caustic soda's installed capacity as well as the production in the last 10 years. You can see there is a steady increase in the capacities of production as well as the actual production, which shows that product growth is sustained and maintained throughout the decade. The installed capacity was around 47.63 lakh MTPA across India in 2021, and in 2021 the production was about 35.60. So the production was lesser than the installed capacity. Capacity utilization was somewhere around 75%. So as and when the demand is generated in this product, the capacities are also increasing. But another way of looking at it is there is a excess capacity as the capacity is also increasing along with the demand. So in such kind of products there will be a lot of competition and the margins will be lower as this is not a specialized product. Now look at the import and export trends of this caustic soda. The import trend in India is going down and the export trend, which is the purple color or the pink colored line, is going up. So India is gradually increasing its exports and reducing its imports, which is good for companies like Meghmani Finechem. Coming to the other products, which are chloromethanes and hydrogen peroxides. Chloromethanes in FY21-22, India's capacity stood at about 477 KTPA KTPA compared to the earlier years, which is 351 KTPA, and this is expected to grow at about 11% CAGR up to the next 5 years. Now, hydrogen peroxide market grew at about 9.5% between 15 to 22, and further it is anticipated that the growth will continue at a CAGR of about 10%. Now, how is this company better than its competitors, or what is the economic moat? This company has forward and backward integration. A lot of products which the company manufactures is captively consumed, so it makes it a integrated player, which gives them lot of operational efficiencies as well as availability of raw material, quality of raw material, prices of raw material are in the hands of the company itself. They have good experience in this field and they have a good leadership team. They have very good manufacturing facilities. They have huge land banks, so even if they want to expand their capacities, they have ample space, and they have well diversified product base, and now even they are expanding into new chemistries, which is making the company risk free in terms of product diversification. What is the growth outlook of the company going further? They have a clear vision or a target to achieve a revenue of 5,000 crores by FY 2027, which is a very ambitious target. A lot of investors in the earnings call are very keen to know how would the company achieve this, because it sounds as a very ambitious target looking at the turnover presently. And as we have discussed, the new product which the company has started, the CPVC resin, since 95% of the product is imported in India, there is huge scope to substitute these imports with the indigenous manufactured product. The company has entered into a joint venture to manufacture 18.34 megawatts of solar power by Q3 FY23, and for FY23, which is the present year, present financial year, they have mentioned some guidance, which is a sales guidance of about 50%, which is 50% higher than FY22. The EBITDA margin is about 26%, but this is lower than the present EBITDA margin, as the company feels that as the volumes rise, the EBITDA may contract a little. 25% on return on capital employed, and the debt they are planning to maintain less than 2x of equity. Now, overall, you see the company is transitioning from the bulk chemicals to the value added or specialty chemicals. In FY22, the share of chlor-alkali is somewhere around 74% and derivatives is 26%. Going further, by FY 2027, the company aims to increase the specialty chemicals share to up to 60%, and automatically the share of the basic chemicals of chlor-alkali will come down to 40%. So, during this transitioning, what will happen? The volumes will increase, the revenue of the company will increase, the margins will also improve because the company is moving into the specialty chemicals business. So the company will make more profits and more margins by doing the same turnover which it was doing earlier in the basic chemicals, and they will further diversify into several products like ECH, CPVC, CMS, H2O2, etc. In terms of integration, the company manufactures the entire value chain of products in the chlor-alkali like ECH, CPVC, CMS, H2O2 and chlorotoluene and the other value chain products in this. So by diversifying into all the product categories, the company is de-risking its business in terms of diversification of product. Here's some update of the capex done by the company recently, which is recently completed, and the ongoing capex. In the epochlorohydrin, the capacity of 50 KTPA is commissioned in Q1 FY23, and CPVC resin has also started Q2 FY23 as planned from 18th of July 2022. So the company is meeting its capex deadlines, which is a good sign. Going further, there are some other plants which are going to be commissioned in Q2 FY23. They are going to start caustic soda with CPV of 106 KTPA and chlorotoluene, and another R&D center of this company is also coming up, which is expected to get completed by Q4 FY24. And at present, the last two projects are in the early stage of about 5 to 10% of the company. In terms of capex spends, in FY22, the company has incurred a capex of about 450 crores, and going further in FY23, they have already incurred 57 crores, and they will additionally spend about 123 crores in the remaining 3 quarters of this year. Now, what are the risks of investing in this company? One of the risks is that the company is into a major share of revenue of the company is into bulk chemicals. So the raw material or the finished product fluctuations across the globe will impact the margins of the company drastically. For a few years or a few quarters, you see that the company is doing really well, and as the material prices fall, you will see the margins contracting and the results going down. So that kind of cyclicality will be there in the business. The availability of raw material will be an issue. If the raw materials are not available, the company will not be able to process the orders, or the prices of the raw materials will impact the margins of the company. The targets which the company is giving are highly ambitious, so you have to see whether the execution wise the company is able to meet those targets or not. In terms of debt, the company has very high debt, so in case any of the project is not successful, the company may end up into liquidity concerns. Another risk is the risk of corporate governance. In the past, there were some corporate governance issues with the company. If you type the company's name in Google, you can easily search and read about it. There were some issues with the promoters and corporate governance of the company in the past. These kind of things you have to keep in mind as investors, as it is always preferred to invest in companies with promoters with clean hands. Now, after understanding the business of the company, let's talk about the financials, starting with the last 5 numbers of revenue. The company's revenue has gone up from about 598 close to 600 crores to 1500 crores in FY22, which is a good number. EBITDA has gone up from 250 crores to 500 crores in FY22. EBITDA margin is slightly reduced from 43% to 33%, and nowadays it is sustaining around 32-33%. But the company expects this margins to go down to 26% going further as the capex is fully utilized. The profit after tax has gone up from 150 crores to 256 crores. You can observe closely that in the profits there are fluctuations. As the company is into bulk chemicals, the margins keep going up and down, so the profit are impacted, and it's not a steady trend of growth in the profits of the company. The profit after tax margin has also gone down to about 16% in FY22. The share capital steadily maintained at about 250 crores. The reserves are steadily growing from about 450 crores in FY18 to about 684 crores in FY22. The borrowings of the company are increasing as the company is doing a lot of capex. Presently, the debt equity ratio is 0.83, but the company plans to borrow more money to invest in its capex, and they have about 780 crores of debt on the balance sheet. This is one area which you have to closely watch for this company, whether there is not much increase in the debt, and the company's liquidity position should be stable if you are invested in the company going further. The trade payables have gone up to about 88 crores from 33 crores in FY18. The fixed assets are about 1000 crores on the balance sheet. In the last 2 years, you see a lot of capex done, and that's why the fixed asset number is up. Inventory has gone up from about 30 crores to about 154 crores. So this is partially in line with the growth in the revenue of the company, but inventory days have also gone up from about 45 days to 50 days earlier to about 74 days. So when the inventory days go up, the company requires more money locked in the working capital, which is not good from liquidity point of view. The trade receivables have gone up from about 76 crores to about 256 crores. Again, partially this is okay from the point of view, from the revenue growth point of view also, but the debtors days have also slightly increased from about 40-45 days to 60 days. So inventory days have gone up, debtor days have gone up. This shows that the company is recovering the money late, and a lot of money is getting locked in the working capital of the company. There's not much cash on the balance sheet. There's just about 25 crores in FY22. The operating cash flow has always been positive in the last 3 years. They have done about 284 crores of cash flow in FY22 in the operating activity. Free cash flow has been most of the times negative as the company has been doing huge capex. The ROCE has gone down from about 36-37% to about 29% as the company has done a lot of investment in its capex, and the ROCE can be further reduced when the further capex is done by the company. Is that what the management is guiding in the earnings call. Now let's talk about the shareholding pattern. The promoters hold about 71% stake in the company. Public holds about 27%. The FIIs, DIIs don't have much stake in the company. This may be due to corporate governance issues in the past. Now let's talk about the valuations and the competitors of the company. As a company, Meghmani Finechem does a revenue of about 1500 crores, EBITDA's margin of about 34%, ROC 29%. Remember, these two will further normalize going further. Trades at a PE of about 20x and market cap to sales of about 3.5x. Few other companies like Gujarat Alkalis and DCM Shriram, they do a revenue of about 3700 crores, EBITDA 26% and ROC about 13%, and trade at a earnings of about 10 times and market cap to sales of about 1.5 times. DCM Shriram is another company which trades at a EBITDA of about, which does a revenue of about 10,000 crores, EBITDA margin of about 20% and ROC of about 25%, and trades at a PE of about 13x and market cap to sales of about 1.5x. So looking at the competitors' valuation who are into similar businesses, Meghmani Finechem presently looks fully priced, and there doesn't seem to be a margin of safety in investing in the company at the present value. The stat auditors of the company are SRBC & Co. LLP, and the company doesn't pay any dividends as it is investing in its growth. Now let's look at the chart. Post demerger, the stock has given a very good rally and made good money for its investors who have invested post demerger, who have held the shares in the pre-demerger itself, and you see a clear uptrend on the charts. In terms of support levels, major support can be seen at somewhere around 1000 rupees, where the valuations will become much more reasonable compared to now, which is trading at about 1500 rupees. So if somebody likes the financials and the growth plans of the company, they can start accumulating the share somewhere around 1000 rupees gradually. But if you are investing in the company, you have to closely monitor the liquidity position of the company, and in companies where there have been corporate governance issues in the past, it is always advisable to keep a stop loss also. Now let's talk about the thesis and antithesis points if you want to invest in the company. The company is a high growth company doing regular capex and entering into new product. Fundamentals are okay, except a few liquidity concerns and working capital management issues. In terms of experience and leadership, the people are experienced to manufacture various chemicals in the present field as well as into the new fields which they are entering. The company has done forward and backward integration, which makes them different from the competitors. In terms of margin, the company's margins are expected to expand as the company is entering from bulk chemicals to value added chemicals in the future. In terms of the antithesis points, the company has high debt, and this debt may go up if the company continues to do capex without generating free cash flow. It's a kind of majority of the businesses right now, the commodity business, so there is a huge fluctuation and cyclicality in the prices of the commodities, which may impact the business of the company. The margins also may be volatile, and this business is highly competitive within India as well as globally. And whatever ambitious growth plans the company's management is guiding for, it is very important that they achieve the targets which they are giving and execute them properly. If at all there is any lapse, there could be a problem for the investors who are invested in the company. So this is about Meghmani Finechem. I hope you like the analysis, the pros and cons both we have covered in this video. If you like the video, hit the like button and share with your friends. And if you want me to make videos on your favorite shares, do comment the name of the company in the comments below. Thank you for watching and have a wonderful day.